People in the English-speaking world believe that property prices inherently rise, that the path to prosperity lies in jumping on the property ladder. But did you know that it's a peculiar part of English-speaking culture to believe these things? Here in Japan, people believe that house prices inherently fall and that house prices or houses themselves are like depreciating assets, are like a car. In Germany, where I was born, renting for your whole life is considered perfectly acceptable because house prices didn't go up for such a long period. But most important of all, we have a little place called Herengracht in Amsterdam. Now, whenever people in Australia or the UK try and tell me that house prices inherently magically go up, I like to tell them about a price index of property prices in Herengracht. But luckily, I'm not the only one banging on about this. I've invited Jan Nieuwenhuijs, who is the editor and founder of the Gold Observer, to explain his recent article about this issue. Now, Jan, I know you own a 5-bedroom villa on Herengracht, but can you explain to us why it's such a special place?
Well, first of all, I don't live on the Herengracht. Yeah, it's a bit of a tongue breaker, right? The Herengracht index. Tough for foreign people to pronounce. But no, the Herengracht is the most beautiful piece of Amsterdam there is. So unfortunately, I don't live there. I live quite nearby actually. But what was the question?
Why is it so special? We're talking here about my favorite piece of economic data of all time. I think this is
Mhm.
even more important than the fact that adjusted for the gold price, an Italian suit for the last 2,000 years has been the same price, the Italian toga and the Italian suit. Even more interesting than that is this property price index from a small part of Amsterdam. Why?
Well, because it's a longest running real estate index. So there was a Dutch economist in the 90s who discovered a book that was published in the 70s. That was when Amsterdam was 750 years old. The book was published, and there was a very special chapter on the Herengracht. And all the houses on the Herengracht were, there was a picture of the houses and but all the data of who owned it and what the transaction prices were, etc. So this economist Piet Eichholt found this data, and he could then in the 90s at first build a price index of the Herengracht, of prices of housing prices. And he used a way to filter out the houses that became offices later on. He only used houses which kept on having a constant quality. First, I think his first index ran from 1623 until 1975 or something. And what you see is that, of course, corrected for inflation, the Herengracht index moves up and down, but it doesn't do that much. If we look at the chart, we can see this is the most recent update, and it covers a wider area of houses of constant quality from 1620 until the third quarter in 2021. And it started in 1620. First, you see it go up. There was because of the VOC, which was our East India Company, and we kind of rule the world here in Holland, and we 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 sell to Asia and brought a lot of spices back and etc. So you see it going up a little bit. Then we got some setbacks. We got into wars with Britain, and there were pest epidemics, and the tulip mania, by the way, didn't do anything for the Herengracht index. So you see it going down a little bit, and then you see it go up because in the 17th century, Amsterdam used to be a trade hub, and it kind of lost that to the British. But then it became a financial center, so property prices, and you see it going up a little bit. Was a lot of economic growth still, and then we lost that financial center to London, and then in the, let's say, 19th century, you see the Herengracht index bottoming until the, let's say, late 19th century, when the Industrial Revolution kicked in here as well, and you see property prices going up. And then it more or less traded sideways until the 1990s, and then it went up because of the what I call the mortgage revolution. And you probably want to ask me some more questions about it.
Yeah, let's focus first though on the period up to the 90s, because that's the part that I find so fascinating.
Ah,
We're talking here about the birthplace of capitalism, really, as I see it. And property prices, adjusted for inflation, adjusted for quality, over that really long period, they went up and down, but the point is that they didn't change much. And I think that goes completely against this belief that I identify with the English speaking world. The property prices, inherently rise over time, and that this is the key to wealth. Now, let's turn to this issue of rising property prices more recently, and the arguments that you identify. And there's a few of them that you mentioned. Let's go first with that mortgage boom. What's the argument there?
okay, so everything changed in the 1990s, and the story about the mortgage revolution is that there are two reasons why the prices went up in the 1990s. First of all, the classic economists like Adam Smith saw land, and also other classic economists saw land as an asset incomparable to other assets because it's in fixed supply and you can't move it around. So when there's, for example, economic growth in a city, or the government builds a train station 500 meters from your house, a lot of things can happen which make your land go up in value. Also, if you play no role in the creation of that value, right? So the capital gains on those in that value used to be taxed by the government. So that was that created land and real estate not to be an investment vehicle, right? Because if you had, for example, if you lived in a house and you got this immense taxes all the time, you couldn't pay for it next to your rent. So you rather would rent a house. So those that was a big factor in, like you said, in Japan or in Germany, they're very used to just renting a house. That used to be the case practically all over the world before 1900. So that changed a little bit in 1900 when the neoclassical economist came and did away with the theories I just mentioned about land, and it rises disproportionately to goods and services because if you have goods and services like, for example, a carton of milk, if the price rises, new supply will come. But with land, if the price rises, no new land is coming. So that's why this is a little bit about the economics of land. And then in the 20th century, something else changed. Until the 1970s, especially in the UK, there was credit guidance. So governments knew, central banks knew, economists knew that if you would create credit solely for mortgages, house prices go up. You get a housing boom, and eventually a bust, and everybody's toast. Um, so what they did, they had credit guidance. They said to banks, the rules are you can only have like 30% of your loan portfolio assigned to mortgages, which makes a lot of sense. So the rest of the credit they lend is to productive businesses. And of course, that creates growth and incomes to service debt, and it all makes sense. Then also it had to do with the Cold War with China. Oh, sorry, with Russia at the time. We had the Cold War with China now. With Russia at the time, because he had communism in the East, and we had the free world, so to say. And in Russia, you couldn't own anything, and governments also wanted to yeah to
Collectivize.
yeah to boost home ownership, and so a lot of reasons. But there was a financial deregulation, and banks were allowed to extend credit to whatever they wanted. And by nature, banks want to lend out more mortgages because that is safer to them. If you lend a mortgage to someone, you get the house as a collateral, and so when the lender or the borrower goes belly up, you can obtain the collateral, and the damage is confined. Now, with loans to businesses, of course, you sometimes the bank has no collateral, and it's more risky. So what happened when the credit guidance was dismantled was that banks started to extend more credit to mortgages. And in the 1990s, in 95, I believe, I also have a chart of this for the UK. You see that in the 90s, mortgage credit as a percentage of GDP overtakes non-mortgage credit. And that is why the insanely housing boom started in the 1990s. There were also another couple of reasons, like they could securitize mortgages, like bundle them, package them, and sell them on. So that would make more room on their balance sheet to extend even more mortgages, lend more to mortgages. So that changed everything from 1620 up till the 90s, and then from the 1990s till now. And after the great financial crisis in 2008, things changed a little bit. Some rules were changed for mortgage lending, but by then, interest rates were very low, and real interest rates were negative. So people kept on buying real estate because you get rent out of it, and also we have still this entrenched idea of of houses always going up in price. So yeah, it has become for many people like the ultimate store of value, and that is something that can change.
Let's quickly mention this idea of the self-sustaining cycle that builds here, in the fact that the more the banks lend properties to mortgagors, and as a result of that, the demand for housing goes up, which increases the value of the collateral, which de-risks the lending process. And then you've got this investor boom and the self-sustaining demand. You call that the housing finance feedback cycle, and you liken it to a Ponzi scheme in your article in the Gold Observer. So explain that connection.
Yeah, well, first of all, I didn't coin the phrase. It's from a book from Josh Ryan Collins, and if anyone is more interested in this topic, I would recommend to read the book. It's called "Why Can't You Afford a Home" by Josh Ryan Collins. Just to make that clear. Yeah, it's a feedback cycle, and because when banks lend mortgages, they fuel housing prices, and when housing prices go up, that creates more demand for mortgages, and so you get this feedback cycle. And another thing that happens is that when housing costs relative to incomes go up, consumers have less to spend, so consumption is dampened, so to say. And so in this housing finance feedback cycle, consumption more and more relies on, let's say, the profits or the unrealized gains on rising real estate. So people, you have the wealth effect that people think, well, my house it has doubled in value in 10 years. I don't need savings. I'm sitting on a fortune. I'm going to spend all my money. Or people take out a second mortgage to buy a boat. Or in my case, my mother could take out a second mortgage to help me finance my house, and etc. And so the cycle goes on.
So what makes this really interesting is I agree with half of it and disagree with the other half. Um, the idea of land being a unique, what's called factor of production by economists,
Hmm.
land, labor, capital is a four factors of production. The idea is that because land can't be moved, it's unique, and historically speaking, it was easily taxed because it couldn't be moved. So if you try and tax something, then it tends to try and escape, and obviously land can't do that. So agree with that, and I agree with this self-sustaining momentum and the shift in lending as well. And I think that's most obvious to the banks in Australia, because in Australia the proportion of lending to mortgages is even more ridiculously high, I believe, than
Yeah.
in the UK. The part where I disagree is I think there's a bigger factor at play. And I think it's one that you're going to agree with me on. You just think it's not as important. And I'd like to point out that in the 90s, this deregulation, these changes were not the only thing occurring. There was also something going on in terms of the euro and monetary policy being shifted inside the eurozone. Um, I think that's a bigger factor here. So I'm curious whether you think as I do about it, and whether you think that's an important factor. And if you do, can you explain in your own words the connection?
Well, what do you mean? So the euro, within the euro area, they formed the eurozone and the euro currency, and all interest rates in advanced economies in the euro went down, and of course that stimulated more mortgage lending.
Well, initially, the effect was felt outside of and Holland and Germany. So you had
Yeah.
one interest rate to rule them all, to go with the Lord of the Rings analogy. which means that the wrong monetary policy is applying everywhere. Interest rates in the initial part of the Eurozone, they were too high for Germany and I believe Holland as well. And they were too low for parts of Southern Europe and Ireland. And as a result of that, you had these booms in property prices in Spain and Ireland especially,
Yeah.
while German and I believe Dutch property prices were suppressed because interest rates were too high, meaning that if the Dutch and the Germans had their own monetary policy, they would have set interest rates lower. And if the Spanish and the Irish had their own monetary policy, they would have set them higher. But because this awkward in between was what prevailed, it encouraged a housing boom in Ireland and Spain. And after 2008, it's reversed, where interest rates are much too low for places like Holland and Germany. And as a result, in Germany, for the first time ever, we've got this epic housing boom. And I would point to the same sequence of events for Holland. So I suspect that is a stronger force here. And one of the reasons for that, I think we're going to get to later on, is your argument that more housing supply is not the solution. But first of all, let's see what your reaction is to the euro issue.
Well, I agree with you, and the interest rate set by the European Central Bank is a one size fits nobody. But you say that at the beginning of let's say this eurozone experiment, interest rates were too high, or no, you said too low for
Well,
the Netherlands, or too high. Sorry, too
too
high
high
for the
for,
Netherlands.
I believe
Yeah,
the Netherlands
yeah,
were connected to. I'm basing my logic on the German house prices more so than the Dutch, just because that's what
absolutely,
I'm more
absolutely,
familiar with.
absolutely. Yeah, no, and the Netherlands and Germany have always have very strong ties. Also before the euro, the Dutch guilder was tied to the German mark. So, but you say that interest rates were too high for the Netherlands, but still in the 1990s, property prices went up spectacularly. So it wasn't only the interest rate issue, but it is a factor, of course, that now we have this financial mush, which makes the ECB lower interest rates to zero or even negative, and that doesn't help this whole housing situation and the subject of unaffordable housing that a lot of countries suffer from. And well, yeah, politicians like to say, well, we have to build more houses. Well, that's not the solution.
Yeah, so I don't know what your prospects are of becoming the Prime Minister of Holland, but if you were, you would not solve this problem by having more houses built. Explain why not, and explain what you would do instead.
Wow. Well, thank God I'm not a policymaker, so this is all hypothetical. So I wouldn't, first of all, I would address the cause of it all, which is throwing more money at a fixed supply of land and houses. So it's the European Central Bank, basically, with its low interest rates, and of course the rules for the banks. Again, I would imply credit guidance. And by the way, I'm just saying I didn't think this through, because I'm an analyst. I like to give critique to all sorts of economists and whatever, and I did not think about what is the best solution, although maybe sometimes I do. But no, I would first of all address that it doesn't make sense to keep the sentence is this: banks can always create money faster than anyone can build houses, right? So building houses is, if the housing prices would fall tomorrow by 25%, suddenly, there would be no shortage of houses again. Suddenly, everybody lives in a house. Hey, everybody has a house, right? So it's a bit ridiculous and maybe that will happen, and then the whole housing crisis is behind us. But it's also dangerous, because if housing prices really fall, like, big time, banks have a lot of exposure to these mortgages, and because they sell mortgage-backed securities to pension funds also have a lot of, as we have learned from 2008, also have a lot of exposure to the housing sector. That's very dangerous. So yeah, it's a slippery slope. You can't really um, make house prices go down. But there are some rules now implemented here, for example, that the government says if you buy a house, you have to live in it for 5 years, and you cannot rent it out. Of course, maybe it works, but we have to focus on the um, main problem, the main cause, which is unrestricted mortgage lending, basically, and low interest rates.
So half of me agrees and half of me disagrees, because if you do the reductio ad absurdum, if you say, we built twice as many houses as there are today, the house prices would fall and there would be more houses and it would solve the problem. But your argument is really that the underlying cause for the unaffordability, which is separate to the supply and demand issue, is the fact that credit for mortgage borrowing is available to an absurd level. And so people would just bid up the price, even if you built more houses. So you would tackle this issue of how much banks can lend, and that would be your priority.
That would be a priority, but also you can't double the amount of houses in 4 or 5 years. How many houses do we have in the Netherlands? Probably 15 million. How are you going to build 15 million houses, right? So it really, what I said earlier, normal supply and demand dynamics don't apply here. So I wouldn't focus on sure, we need to keep on building some houses, and specifically for students, they can live in smaller houses and etc. But we have to shift our focus off of the building more houses. It just doesn't help. The cause is big, more money is being thrown at it, and also now, because of the negative real interest rates, everybody's savings are going into it. It's not only the mortgage lending and the interest rates. It just, we're in a very unfortunate position.
Yeah, let's quickly mention that negative real interest rate issue, the idea that you're better off buying a house and having your savings in the bank. Can you explain that to people?
Yeah, so now when you have money on the bank, you don't get any interest on it, but inflation, I believe in the Netherlands, is now like 3 or 3.5% or something. I don't know. It's above the average. So actually, what happens to your savings is that you lose 3.5% a year. And so, so the real interest rate is minus 3.5%. Now, not only that, a lot of mortgages in Europe can also be tied to the nominal mortgage rate. So the interest rate you pay on your mortgage can be tied to, let's say, capital markets. So more and more nominal mortgage rates are actually negative. So that means that not only, interest rates in general, real interest rates in general are negative. That means that if you take out a mortgage, you get paid every month to borrow money from the bank, own a house, bid up its price, extract rent. It's peak insanity.
Yeah, the the absurdity of it is sort of highlighted by the fact that you're an idiot if you don't buy a house, right?
Yeah.
You effectively have to. But before we turn to what happens next, this after a peak insanity, after these bizarre booms and bubbles, there's obviously a bust. But before I forget, I want to mention something ironic that I learned from your piece in the Gold Observer, which is that you say that the supply of land is fixed, but ironically enough, how do I say Herengracht?
Herengracht, yeah.
Herengracht is ironically a reclaimed land. Is that correct?
No, it was land, and it was the canal was dug out. There's a lot of reclaimed land in the Netherlands, but
Yeah.
not the Herengracht.
No,
No.
so it was the canal they built, not the reclaimed land. But it reminds me of Russell Napier's recent book about the Asian financial crisis, and he writes about this issue that land is a fixed supply, so it's economically different to the other factors of production. And he wrote this newsletter that the book is about, looking over a huge parcel of land that was reclaimed land, and so he writes about how ironic that is. But
Yeah,
anyway,
there is, of course, you can, like in Dubai also, the Dutch are quite famous for reclaiming land, and you can do it a little bit, but
it doesn't
obviously,
change the underlying argument. Yeah, I agree.
no.
So let's turn to this peak insanity. Everyone's forced to buy a house because their savings in the bank is losing money adjusted for inflation. What happens next? How did it all go wrong?
Well, I think that eventually the mortgage lending will run into some kind of wall. For example, yeah, I'm just gonna throw in some numbers here. Banks cannot lend me 1 million euros when my income is 2,000 euros a month, right? I mean, eventually the will run into, and things will get stuck. Just as and when mortgage lending stops, a lot of people's savings and capital can still move into real estate, but eventually, gravity becomes an issue, and either prices will go down. But that's a problem for, like I said, for the bank. It can tear down the banking system because mortgages. If you think about banks now, or me in the Netherlands, if I think about banks, they're primarily in the business of mortgage lending. 100 years ago, they were not. They were primarily in the business of lending to productive businesses. Anyway, so that is a danger. So I think central banks want to, and they are actually, if you look at what they do and not what they say, they are supporting this housing market. And just like in 2010, I got a loan from the government that made it possible for me to get a mortgage from the bank because I didn't have enough money back then. So they support this housing boom, and economist Josh Ryan Collins calls this asset-based welfare, right? So how will it all unravel? Yeah, it's very likely that inflation, maybe nominal housing prices will top or move sideways, and then inflation will go up, so that real housing prices will come down again to some more normal levels. And I also hope that economists and policymakers will change the rules again, implement credit guidance, think about land tax again. Of course, I own a house. I wouldn't be happy with it, but I would rather. I'm a capitalist, but still, I very much like to think about, how do we want to live in a country, right? We haven't talked about inequality, for example. Like people that bought a house 10 years ago or 20 years ago are so much better off than people that didn't, or waited, or had some stuff and they couldn't do it, or people that are coming off university and they can't enter the market because and this is Amsterdam. This is not even London or New York.
I like that idea of asset-based welfare. Um, One of the points I want to mention is I actually almost completed a PhD on some of the issues you just mentioned there when they relate to Australia. And in Australia, the way bankers were able to lend $1 million to people who are on $2,000 incomes was they would just put a 1 in front of the 2 on the mortgage application. And so the banker or the mortgage broker would make this little addition, and suddenly your monthly income was $12,000 instead of 2. And as a result of that, you're able to afford the mortgage. And this was a big, major issue. And as a result, there was a Royal Commission which exposed it. It was a systemic problem. Despite this being exposed and the scale of it to a great extent, house prices didn't fall. And I really want to emphasize this for the people watching. As long as house prices rise, even if you default on your mortgage, the bank is safe because the collateral, the asset that they get when you default, has risen enough in price to cover the mortgage, the underlying mortgage. So it's very much a case of, as long as the music continues, everyone can continue to dance. And so all of the focus is on the music, which is the house prices rising. And that's that asset-based welfare, the asset price welfare. As long as those underlying assets are rising in value, the whole game can continue. So my prediction for Australia was that all it took was a dip in house prices for the whole thing to blow up. And yet I was wrong. Australian house prices did dip and it still didn't blow up. So I think there's an extraordinary force behind all of this, especially in the English-speaking world. And maybe Dutch politics or German politics as well will wake up to the underlying issue here, which is this bank push for rising house prices.
The banks have an incentive that prices go up for their collateral. Yeah. You didn't tell me you were a PhD in.
I was this close to
economics.
finishing, but my
Okay.
supervisor kept on resigning because all of a sudden my topic was mainstream news because of the Royal Commission. So they didn't want to have a student publishing something that undermined a Royal Commission. But let's not go there. Let's talk about gold for a while, because gold's been an important part of Fortune and Freedom since we launched. which was October last year, I believe, or a little bit before that. But the gold price in that time has not performed very well. Now, you're an expert on gold. Explain to me why the gold price has not risen since, I think it's August of last year.
Well, the gold price is more or less a function of inflation expectations and interest rates in the US. So I don't know if you have heard of TIPS bonds, Treasury inflation protected securities. If you look at the 10-year TIPS bond yield, it correlates more or less perfectly with the price of gold. So what's happening now is that, yes, inflation expectations came from a very low at March 2020. It was very low. It was like, I don't know, 0.5%. So they've climbed up and they're making the 10-year inflation expectations, which you can derive from the TIPS bonds. They're making multiple year highs now, but interest rates also are going up. So that is why gold is a little bit stuck at this moment. And for the gold price to continue to rise, what would need to happen is that inflation expectations, or inflation in general, would continue to rise, and then interest rates would be kept, like what was done after the Second World War, when countries like the US and also the UK had immense government debt to GDP levels. So what they did was just to print a lot of money, simply put, let inflation run wild, put yield curve control over the total yield curve. Sorry, my English is very bad. It's in the morning here. Yeah. And so then you get a massive negative real interest rates. And in that environment, gold can flourish. So I'm not expecting a lot from gold in the coming months, but I think that and you see it now, that also with inflation being more persistent, central banks want to raise interest rates, or you see interest rates rising in countries. Yeah, eventually, when we have never had this much debt in the world. Global debt to GDP is about 350% at the time of writing. So if interest rates go up, I mean, that debt becomes more unsustainable by the day. So I think they have to put in yield curve control and very negative real interest rates to get out of this debt burden, and gold will profit from that.
Yeah, so what you're talking about are issues that we like to cover a lot: financial repression and this inflation issue. Let's quickly explain that TIPS idea, because I think that's a good way of understanding this. So you've got treasury bonds, which are a loan to the government that pays interest. And then you've got inflation protected treasury bonds, which means that if inflation goes up, your interest that you're earning on that also goes up. And so the divergence between the two, between the bonds that are not inflation protected and the bonds that are inflation protected, tells you what people expect inflation to be. And so gold, because gold likes inflation, it tends to follow that difference between the TIPS and the normal bonds.
Yeah.
And the next issue that you raised is following on from that, what happens when governments get into so much debt that the only way they can escape is by causing a lot of inflation, which makes their debt worth less over time. This would also solve the housing problem that we've been discussing, because as the value of money falls, if the house prices don't rise, then really house prices are falling, adjusted for inflation. But governments can use this as a policy mechanism in order to basically indirectly tax people who have their lent to the government. And so it's a form of secretive theft the governments historically have used to try and escape from borrowing too much because of a war. And so after these periods, it's very dangerous to be an owner of government bonds, because the inflation will make that loan worth less over time. And the alternative to this government bond investment is gold, because it does protect you from inflation, although it doesn't earn the income. So you're expecting gold to perform and outperform in the longer run. I still feel disappointed that over the last few months we've had what many people would have described as the perfect environment for gold, and yet the gold price has not performed. Do you think there's going to be something like the 60s and 70s then, where it takes inflation to really take off and people to really realize that interest rates are not going to rise before the gold price moves?
Yeah, it could be. It could be. I think it's there are a lot of things going on right now that can cause very high inflation. Let's first of all address climate change or the policies to prevent climate change. You know, the policies of, for example, my government are very noble, but as we say here, don't throw away your old shoes before you have new shoes, right? So don't close the gas factories and the oil production and everything before you have a new energy system set up. So that whole energy transition is very, let's say, inefficient, and it makes energy prices very high, which translates into consumer price inflation. Then you have COVID, which is not going to go away. It will never go away. Or yeah, maybe in some countries like in Australia, I don't know what they're doing, but um, fact of the matter is that COVID is also making the economy less and less efficient. So everything is more expensive. Also because how policymakers try to tackle COVID, but let's not go there. So it makes supply chains more inefficient and also makes commodities more expensive. So that translates into more inflation. And then so you have all these problems, let's say on the supply side, while central banks keep throwing liquidity on the demand side into the economy. So that is kind of a good recipe for inflation. Yeah. So I do think that we can see a situation quite similar to the 1970s. And also, I want to say that, and maybe I would also like to hear your opinion about it, that gold is now very much correlated to the TIPS bond, but that doesn't have to last. Correlations are not written in stone. For example, if the tips bond yield is -1 and it stays there for 10 years, in the current framework, gold would move, but that doesn't make sense to me. I mean, gold would continue to move upwards if real interest rates or expected real interest rates are negative. So we just have to. There's still a lot of trust in the financial system as it is right now, but you know it's very hard to predict the future, but you can prepare for it.
Yeah, I think that key word there is trust. If you don't trust the financial system, gold is your way out. So if strange things start happening in the bond market, such as in the tips market, which you mentioned, then more people will flock to gold over time. Right now, my key question for gold is whether or not there's going to be another 2008 style crash or not before inflation does take off, as you and I expect. In other words, will central bankers actually tighten monetary policy in coming months and trigger another crisis because there's so much debt, as you mentioned? Or will the inflation continue to surge as it has in recent months?
Difficult. I don't think, if I look at what central bankers have done in the past 10 years, they will do everything to continue growth and not cause a recession or whatever. They will just, we have almost forgotten, but in like 30 years ago, a recession was a good thing because it would liquidate the market, and we had creative destruction and whatever. And now recessions are like ooh ooh ooh, and of course everything is in a bubble, from the stock market to real estate to whatever. So I think central bankers would just go on with low interest rates and QE and or helicopter money, whatever. That's what I think.
I hope I get a chance to ask you about it again in a year's time when we find out what happened, because I can't make up my mind between the two. Jan, how do people find out more about you and the Gold Observer?
Well, I have a website called the Gold Observer. It's on Substack. So you can go to thegoldobserver.substack.com, or I also bought the URL thegoldobserver.com. You'll get there, and you can subscribe and you get free emails to read the articles. You can also support me in my research in gold, because I also cover some other topics like the possibility of central banks revaluing gold to write off bad debt, because all the debt in society now flows to the central bank balance sheets. Now, how to get off? that maybe they will revalue gold and they have a lot of let's say unrealized gains on the liability side, which they can use to write off bad assets on the asset side, things like that. But anyway, yeah, the Gold Observer, it's pretty straightforward, and you can check it out.
I really want to hear the story of what got you started and made you so famous in the gold world. It's a long running story and it's a question of China's gold reserves, I believe. I don't know what the full story is, so I want to hear it from you.
Yeah, well, I used to be a sound engineer in the movie industry. I recorded sound for TV series and movies. And I got a surgery on my knee, and I couldn't walk for a couple of years. And my hobby was actually economics, just reading about economics. And but then with my knee, I was homebound, and I started a blog about the Chinese gold market and what's practically no one in the English speaking world knew was at the time in 2013, 2014, how much physical gold China was actually buying. And I did a whole analysis on that, and first people laughed at me, and then I was right, and I gathered some fame, and I was offered a job at a precious metals dealer, and I started working as a gold analyst, and from there I worked at another company, and then I started my own website because I like to have my own freedom and just follow my heart in what I research and write.
Jan, thanks very much for joining me, and everyone at home, thanks for joining us.